We have a problem. Welcome back, everybody, to Financial Friends. This is a community of people who love business, finance, and investing. So if that's you, hit the subscribe button, join the ever-growing friend group. Before we get started, also hit the like button on this video if you enjoy finance content, business content about the economy, and stick around. Give your thoughts and opinions down below in the comments. Let's go ahead and dive into why we have a problem, and a big problem at that. So you got a sneak peek here, savings and interest rates. Now I'm going to give a little broad overview, then we'll dive into the specifics, but savings over time is beginning to dwindle. Potentially a good sign for inflation in the economy, and interest rates are continuing to go up. Now, here lies in the problem. Spending, which helps to fuel higher inflation rates, is continuing to go up as well. In this video, we're going to dive into what is going on, why there is a potential problem, and what you as an individual can do about this problem. Now, let's dive into things. The Federal Reserve has set interest rates higher and higher and higher and higher over the last couple of meetings and over the last couple of months. But you can see this inflection point here in February when they did start to go up. The problem with that's here in 2022. And we saw inflation much before that, and we're continuing to see inflation after that. That's the problem. Inflation is continuing to rise, meaning prices of things are continuing to go up at the same time that we are raising the interest rate, federal funds rate, which is inherently affecting your personal loans, your variable rate mortgages, your variable rate debt as a whole, making it more expensive to make payments, while eggs, milk, bread, and all the other essentials are continuing to become more expensive as well. Diving further into this problem, we can see that previous data thought we had about $2.4 trillion in savings within households in the United States, and we had spent about $270 billion of that savings, meaning we're having to dip into savings to make sure that we can pay for the things we need. Now, new data has came out and said, look, that 2.4 trillion, that was a little high. It was actually 2.1 trillion. We didn't spend 270 billion. We actually spent 630 billion, or a 20% increase in the excess of peak savings, meaning now we've already spent 31% up from that previous 11% number. That is a pretty stark difference right there. Now, just taking that one piece of information, you can spin it a couple of ways. Of course, this could be a bad thing because we're running out of money in that savings, meaning that potentially these new loan delinquencies are going to start to creep up. But both of those things paired together means that potentially the Federal Reserve has done their job, that these are small positive signs. Now, of course, we're only down here, meaning we're only seeing a small amount of increase in new loan delinquencies. We're only seeing a small amount of our overall cash pile get dwindled. However, these are signs that what the Federal Reserve is doing is working, and that maybe they should begin to slowly back off in some way, shape, or form. And I'm here to tell you, and this is really the pinnacle of this whole video, that's not necessarily the case. So, diving into some more information, we can see here that, as I mentioned previously, signs of deteriorating consumer credit and having less excess cash could potentially be good points for the Federal Reserve to pivot, and instead of continuing to raise interest rates, maybe what they're doing is working. Now, of course, before we dive into that other data, it's not working. We're not seeing a decrease in inflation. That is really the point of what the Federal Reserve is doing. Yes, spending coming down or dwindling our cash or loans going up is potentially signs that that could happen, but it's not. Now, this is where we get into something, like I already mentioned, the pinnacle, the really tricky part. The top two income quintiles, or the top 40% of income earners in the United States, make up 60% of overall consumption. And remember, consumption in general is what can drive inflation. Think of it this way. If you have a product at $10 and somebody buys it, that means the business is going to think, let's raise it to 12. If at $12 someone buys it, they can raise it to 14. If at 14 someone buys it, they can raise it to 16. And that can continue to go on, especially as on the back end, everything that goes into the product that business is making is also getting more expensive because of the same phenomenon. So we're going to have to cause pain to the very top income levels, the top 2 quintiles, to help that demand that they are still fueling come down. And the group that's going to be most broadly hurt has the lowest amount of impact on shrinking that demand for spending money. And that's that bottom quintile there, that last 20% of people that only make up roughly 9, and I just rounded up to 10 for purposes of making this chart, the 10% of spending. So the people who can bear this the least amount are going to feel the most amount of pain. And the people that can bear this the most are going to then cause that pain for people further down the totem pole. Now, I am not knocking people who are making a lot of money, nor am I making fun of anybody who is in the lower quintile. But what I am saying, this chart demonstrates a very clear problem with the income gap. It's that the top income earners can afford to spend the most, can afford to keep this vicious cycle that we currently have going on. They can keep it going the longest, and the people that can't bear that are the people who you might be seeing in this chart going delinquent on their loans. And so what the Federal Reserve is going to have to do is continue to cause more pain to this top 40%, leaving this bottom 20% in an even worse predicament. Now, what can you do regardless of where you fall on that chart? There's 3 main things, and I'm going to throw a 4th one in there as well. Let's start with the 4th one. Raise your income. I know it sounds simple. I know it's easier said than done. But if you can move from a position where you might be making X to making 2X or 3X or even 1.5X, that is a beneficial step for you with more money in your pocket so that you can do these things here. Keep debt levels low. Variable rate debt, any type of debt that could be affected by the increase in interest rates, is going to be debt you don't want to have because it's going to get more expensive. That ties perfectly in with keeping expenses low. If there is something that you can control in this period moving forward, you should probably tamper it, control it. Keep that expense low so you can continue to service other debt and potentially do that middle one there, build an emergency fund. Now is not the time to sell a position that is at an all-time or 52-week low. If you're selling something and getting pennies on the dollar for it, it means 2 things. 1, you got pennies on the dollar for it. And number 2, you don't have that asset moving forward when inevitably, at least in my personal opinion, we do move out of this, whatever that time frame looks like. So, this has been another video on Financial Friends. If you did enjoy this video, please hit that like button down below. These videos take a good chunk of time to put together. All of your support is greatly appreciated. Share this video with a friend. If you learned something or found it interesting, make sure that someone else can learn it as well. Have them join the friend group here on YouTube. If you're looking for content daily, TikTok, Instagram, and Twitter are the spots for you. Thank you very much for tuning in. Leave your thoughts down below in the comments, and I will see you all in the next one. Take care.